Welcome to my channel. I'm the cover call guy, and my goal is to reach $120,000 per year in passive income using only cover call ETFs. My portfolio currently uses $70,000 a year and about $6,000 per month. Legal disclaimer before we start: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making financial decisions. I'm just some random idiot you found online, and I could be completely wrong. With that out the way, let's get on today's video, and it's going to be: why does YieldMax get so much hate? Does it deserve it, right? And disclaimer before we start: I do not hate YieldMax, right? I always make a video, and then if a YieldMax get mentioned and it gets put into a section where, oh, don't, I wouldn't own it, this and that, and then I get a comment saying, oh, like, you're a hater. I'm not, right? I don't hate YieldMax, right? It may not work for me, but it might work for you. Again, it's all in what it does. Is YieldMax does a specific job that doesn't fit my portfolio criteria and requirements to sustain my lifestyle. However, it may fit your portfolio and your criteria to sustain your lifestyle, and I have nothing against it. I made this. I didn't make this based on like the comments, but it's been going around. There's a YouTube video on the YieldMax, one of their I'm not sure if it was the YieldMax CEO doing an interview with, I think, YouTuber names was like Marcos, and he was just trying to respond to like why YieldMax get all the hate. Does it deserve it? And then if you go in the Reddit subreddit community, even YieldMax, the people that own it are like very iffy about what's happening. And YieldMax is trying to release a new funds of fund, or 25 funds of fund ETF. So that's gonna be interesting to watch. I don't know when it's releasing, but it is releasing soon. I think end of this month or early December. But yeah, let's get started. Why does YieldMax get so much hate, and does it deserve it? Again, it's my opinions. I just did the research, put it together, gave my thoughts on it, and I'm just talking about it. Maybe you guys have a different view. Maybe you guys agree. Again, I don't hate YieldMax. All right, I don't hate any ETF or stock. It just doesn't work for me right now. It might work for me in the future, but as of right now, it's not in my portfolio, and I don't think I would be owning it anytime soon, unless maybe they come out with an ETF that actually does fit my criteria and my portfolio. All right, fallacy 1, the price is collapsing, right? TSLY. The hate about this is that price only return 1 year is negative. It's basically negative 50, but the total return since inception is plus 64.53%. The critics see the price, investors get total return, right? However, it's the quality of that return that is the real problem. Right, we'll take for example NVIDIA, NVDY from YieldMax. This is the divergence, right? Price only return year to date is negative 30%. Total return plus 300%. So what is the quality, right? It's the source of the return. Is it real income or just your own money back, right? Return of capital. Is it tax efficient or tax toxic? So again, the people who hold these YieldMax products, if they bought it since inception, they're up, they're good. Of course, they don't understand why people hate it, right? But not everybody bought it when it came out. And a good stock, no matter when you buy it, or good ETF, no matter when you buy it, right? In my opinion, a good stock or ETF, no matter when you buy it, it should be staying the same steady, right? Or going up gradually, right? It shouldn't just be dropping in price. For those who bought it since inception, yeah, you did well. You guys, TSLY, if you bought it since inception and still had it, the total return, you would, I guess, still be up around like 20-something%. And then NVDY, you still be up over 250%, 270%, right? So of course you're gonna say, yeah, of course, it's a great company, it's a great fund, it's a great ETF. But for those who didn't get in when you got in to get those type of total return, they might see in a different view, different light. Fallacy 2, but total return is good, right? The total return trap, this is from a Morningstar analysis, found that for 28 funds, excluding Misty, investors suffered a negative $320 million in cumulative loss. Right? The funds are engineered to wrong foot investors. This means high yield attract investors after a big run up. They buy high, get caught in the fall, and sell low. Right? The average investor's actual dollar return is negative. Even the fund's total return is positive, and that's what I mean. If you were to buy since the beginning, you've made out. You've basically got the big run up. But for those who bought after it, they got caught in the fall and they had to either sell or try to make up the losses and break even. Problem 1, the yield is a return of capital. What is return of capital? What is ROC? It is not a profit or dividend. It's the fund returning your principal. It's an accounting illusion that guaranteed NAV erosion for YieldMax, right? And this high, is this high return on capital bad for YieldMax? Yes. It just means the yield isn't real income. The critics who see NAV erosion are right about the symptom, but this is the disease, right? Right now it's infecting all of their ETFs, and there's like, if they're not, the fund manager themselves are not trying to treat the symptom to fix the disease. It's just letting it spread, and every new ETF they're releasing, it's like basically the same problem. If you read up on, you know, their the comments section of their subreddit or on X, on their official page, it's like every investor that hold their ETFs are like, why are you releasing new ETFs if you don't even fix the initial problem we have now? And then the flagship funds, right? YMAX 95% ROC, YMAG 97% ROC, Misty 96% ROC, and Chippy 100%. Problem 2, the ROC time bomb, right? Using YMAX as an example. The tax deferred trap. ROC isn't taxed today. It just reduces your cost basis. Once your cost basis hit 0, all future distribution becomes 100% taxable. YMAX annual distribution is about 70%. Annual cost basis erosion is at 65%. An investor buying YMAX today will face this time bomb in about 18 months. Right? This depletion happens to your initial shares regardless of reinvestment. It is an unavoidable countdown for these YMAX products. Problem 3, the structural tax inefficiency, right? 37% ordinary income rate is absolutely insane. The conversion, right? The fund strategy convert potential 15 to 20% long-term capital gains from just holding a stock and structurally converts them into a 37% ordinary income from short-term options. This is a massive built-in wealth transfer from the investor to the IRS. It's a tax inefficient by design. You were literally giving your money away to Uncle Sam. How does the tax structure work? All right, so the 50 plus ETF or tax toxic losers, in my opinion. All right, trade options on single stock like Tesla or ETFs ARK. These do not qualify for special tax treatment. The result of this, 100% of gains are taxed as ordinary income. That is absolutely disgusting at 37%. And then I did find like 3 tax advantage winners. There was 3 good ones that I was like, okay, this is not bad, right? They got 3. SDTY, QDTY, RDTY, right? Trade options on a broad-based index, SP 500. These qualify as a Section 1256 contracts, which is a 60-40 tax advantage at 27%. Problem 4, negatively assess a systematic risk. Capped upside, right? 2023, Amazon went up 80%, AMZY up 18%, captured 22%, missed 77% of the rally. 2024, Amazon went 44%, AMZY went 35%, captured 79%, but it was inconsistent. Full downside, right? Now I'm gonna use hypothetical. Tesla drops 30%. TSLY collects a 5% premium. Result, TSLY still dropped 25%. Investors capture a fraction of the upside but participate in nearly all of the downside. Again, this might be okay for some people, and it might not be for other people like myself. I want an cover call ETF that buffers the downside and capture more of the upside. A YMAX product does not do these things. Problem 5, poor risk adjustment returns. So we just heard that this is just a graph showing that investors in NVDY are not being compensated for the massive additional risk they are taking versus a competitor like JEPQ. You just have a better chance investing in JEPQ versus almost all of the YMAX ETF. But they see the yield and they think they're getting a better return. However, these ETFs dropped so much in NAV, and the return of capital is pretty much erodes after a year and a half, that you pay more than you actually gained. The vast majority, facts to back it up, and this is just a chart of my facts to back it up. The fact they destroyed NAV via return of capital, YMAX MISTY, right, or tax toxic, even with a 0% return of capital. TSLY, NVDY have negative returns. That's insane. The exception, right? I did find 5 qualified ETFs, right? Group 1, the tax advantage, which is SDTY, QDTY, RDTY, as I mentioned. They solved the tax problem. They use Section 1256 index options, but they still have a high return of capital and unproven returns because we've been in a bull market. Verdict: qualified taxable taxes. Group 2, I would say these are the 2 most sustainable. Biggie and Soxy solves the return on capital problem, targets a 12% yield, so it's high, but it's not too high. It's in the sweet spot, the Goldilocks range. I like it, with a 0% return of capital so far. However, it is still tax inefficient at ordinary income. My verdict is that it's qualified in an IRA account if you have it in an IRA. And then these are just defensible groups, right? The zero date expirations, right? The ETFs, SDTY, QDTY, RDTY, right? Solves the number 1 problem, is tax, trades on broad liquid index. However, con is still very new, unproven, modest return so far, plus 13, which is not bad. It's really not bad, but it's still low if you're talking about a cover call ETF. Distribution have a 100% return of capital, right? Use case, I would probably only use this for a taxable account. I keep a very, very active eye on it. And then group 2, the target 12, Big C and Soxy solves the number 2 problem, return on capital, right? Pros, 0 return on capital means the 12% yield is a real sustainable income. However, it's still tax efficient. It's still new and unproven. Had to keep an eye on it. The model isn't perfect, right? Uses like the other target 12 uses the 90, like a return on capital at like 96%. The use case for this, in my opinion, would only be for a tax advantage account like an IRA. My verdict: YieldMax does deserve the hate, but for the wrong reasons, right? The real problem isn't just NAV erosion, it's the actual structural tax inefficiency and capital destruction. When you buy these products, you have to understand that you are basically gambling with your capital appreciation. You may be getting a high payout, but at the cost of just switching the dollar bill back and forth. And at some point, when it gets to a zero cost basis, you are going to have to pay taxes while you watch your stock fall in price. Final verdict here: the only appropriate use cases, just to summarize: do not buy if you are a long-term investor, you are using a taxable account, except the 0 date time expiration options ETF. You believe this is a safe, high yield. No one really should be buying this, but I mean, that's just my opinion. Narrow use case, I guess in a tax advantage account like IRA, 401k, you can consider like Big C and Soxy for the 0% return of capital. Tax taxable account, I would, I guess, choose these two, SDTY and QDTY for the section 1256. But really, the YieldMax, again, I'm making a disclaimer. I don't hate the YieldMax. I don't hate any of the ETFs. I don't really, I mean, anybody who buys it, I mean, that's really up to them. That's what fits their narrative, where whatever their life goal is just not going to fit mine. And this is my opinion, and, you know, I might get a lot of hate for it. But YieldMax products, honestly, there's so much more better options out there, right? If you guys watch my channel, there's just a lot more better choices. The high yield is fugazi. It's fake. They're tricking you with those numbers. They're just really exchanging your money, putting their pocket, giving it back to you, while they collect an expense ratio, the fee. So again, I don't know, maybe you guys disagree. Let me know. You guys agree, let me know. Subscribe, comment, like. I appreciate it. I already know I'm probably gonna get a lot of, you know, hate that I'm talking about YMAX and how I wouldn't buy it. But thanks for watching. Stay tuned. Catch you guys on the next.